or we're emerging market has to position themselves. We're not that little puppy that everybody loves. We're a little bit of I don't know what we're turning out, whether we're a thoroughbred or a little bit of a mongrel. I'm still trying to work out where they're positioning, where they're putting us.
I think it's called Canis Africanus. David, we have to leave it there. Thank you very much for taking the time to speak to us. It's David Shapiro from Sasfin on the line from New York. While the European Union is about to slap tariffs on Chinese solar panels, South Africa ahead of the curve and has a relatively successful local procurement strategy in the renewable energy space. That's according to Paul Semple. He's portfolio manager at Future Growth. He joins us now on the line from Cape Town. Paul, thanks very much for joining us. Well, when we talk about renewable energy, what sorts of opportunities does this open for South African investors?
Stephen, thank you. Yeah, it opens up a whole new investment for the capital market. Currently, there are 28 projects around the country that are being constructed, and we estimate that around 100 billion rand of new investment will be required over the next 2 to 3 years.
And where is that money coming from, Paul?
Right now, it's all coming from the local capital market, and from the banks as well as the asset managers, including Future Growth.
And the appetite from investors?
Sorry, say again?
The appetite from investors to buy those bonds, such as Future Growth is selling?
You mean the private market?
Yes.
Consumer market. Right now, only the pension funds are effectively accessing this market through the asset managers.
Well, I mean, when we're talking about Chinese imports being slapped with these tariffs into the European Union, are we doing similar in South Africa? Should we be doing similar in South Africa? Should we be sourcing more of those renewables locally?
Well, in that regard, I think South Africa has been very proactive in that the government has already required producers to source locally up to 40%, or right now a minimum of 40% of all equipment procurement must come from South Africa. And government is targeting an increase to 60%. So they're already aware of the threat from international supply, and they are targeting local production.
Nerina, as an asset class, what sort of growth are you seeing in the renewable space?
There's very strong demand for it. I think it is certainly supported by the demand from the pension fund sector. I think we certainly have to thank the Government Employee Pension Fund because of the strong focus in terms of sustainable investment, and clearly this falls right bang in the middle of that. So with the restatement of Regulation 28 of the Pension Fund Act, this is something that got specific focus. So there's a very strong structural supporting argument for this. So as he says quite rightly, there's strong support from the pension fund institutional market at this stage. There's limited access for the retail investor at this stage, but that certainly would be the next phase in terms of this. We've also just seen the second round of the renewable energy program of government being concluded to the tune of about 28 billion rand, and the third round is expected to be concluded by August. So there's a strong growth pattern in all of this. Most of those were wind and solar energy plants, and of course it couldn't come at a better time, considering that we're probably going to have another winter with some Eskom problems again this year.
The benefits beyond the investment returns and the likes you're seeing, Paul, how about carbon footprints? Because we know that thermal energy contributes about half of South Africa's carbon footprints, and we do sit with a particularly high one. What's the potential for this to come down as renewable a greater role?
Yeah, and South Africa has the 10th biggest carbon footprint in the world, so there's a massive drive to reduce that, and there's huge potential through renewable energy. 40% of all new generation capacity is being targeted from renewable energy. So we believe that carbon footprint is going to be materially impacted positively by the rollout of renewable plants.
And apart from getting a good CSI credits, what sort of returns would investors in this space be looking at?
They would be looking at risk-adjusted returns, so very much in line with the returns or the interest rates that banks would charge.
Paul, we have to leave it there. It's Paul Semple, portfolio manager at Future Growth. Thanks very much for taking the time to speak to us. On the Arena Fisser, head of Beta Solutions, Nedbank Capital, still with us in studio to talk us through our two charts of the day. With all the talk of an interest rate cut, these give some perspective on how this relates to household debts. The first chart shows debt summonses extending their 2.5-year downtrend as low interest rates relieve pressure on finances. The second chart shows household debt to disposable incomes following the same pattern and dipping along with lower interest rates. Is there a direct link, Nerina, to interest rate cuts and consumer debt as a percentage of household spending?
Yes, certainly. I think the first one paints maybe too rosy a picture, because I think the base there certainly plays a role in terms of the sharp decline in debt summonses. We've got interest rates at close to 40-year lows in South Africa, and that clearly has played a role. But because the unemployment scenario in South Africa is not just relatively, very poor. I mean, this week we saw the official unemployment rate at 25%. We see today again that mining and manufacturing growth is still very poor also. So it means that there's lack of capacity to actually improve the ability to repay even the debt that is there. So although we've got